Hello and welcome back to this course on IFRS 15. In the previous videos, we have discussed about the first two steps, which was the understanding whether there is a contract or not, and then we were understanding the separate performance obligations. The step three is to determine what is the transaction price. So, as per IFRS 15, the transaction price basically the definition is there any amount of consideration which the companies are expected to receive or pay for the exchange of the goods and services among themselves, excluding the amount collected on behalf of third parties. So it's not does not include the reimbursement where you need to pay exactly the same amount to an outside company, which is being disclosed in the beginning. So, for example, if you are saying that we will come and let's say there is a elevator service company which is going to deliver the elevator at the property, and because the price may include only at the factory, so the elevator company may say, okay, we will be delivering it to you, but we will be collecting a delivery charge which is going to be paid to a third party, and this is the charge. So the billing is done directly to in the name of the buyer, not in the name of the seller, but the money is paid by the seller first and then collected from the buyer. So in that case, the amount will be considered as amount collected on behalf of third parties, because they are really the third parties which has a direct relationship, we're supposed to have a direct relationship with the buyer, or with the buyer, and the seller is just collecting on behalf of them to pay directly, so without making any margin. But if they decide to make a margin and the billing is done to the seller and then included in the price to the buyer, then it is not amount collected on behalf of third party, because the company is might be making a margin on it. So the amount which is being promised, or which is for the or being actually transferred in terms of the exchange, so it can be transferred immediately or it can be transferred in the future. It can be transferred in the value, in the variable considerations, in kind, or in kind or in cash, right? So there are certain variables that we have to consider when we are determining the transaction prices, which includes variable considerations, which we will look in the next slide. And it also may contain some estimates for variable consideration, for example the warranty periods. And then it may also include certain financial component, for example the time value of money when the transaction is happening over a period of more than a year. There always a time value of money. Then you have non-cash transactions where you are having an exchange of goods and services, which has to be done at a fair value. And then there is consideration payable to a supplier for distinct goods and services as purchase, for not distributed not non-distributed services as a reduction in the transaction price. So payable back to payable back to a consumer. So now what are the variable considerations? The variable considerations includes the performance bonus or penalties or right of return or incentive discounts, clawback. So these are the examples of variable consideration where the buyer is paying either performance bonus. Let's say the company has done a outsourcing contract for, in our previous example, for the elevators. If the company is able to install the elevator in, let's say, a week, they are supposed to get a performance bonus of, let's say, another 10%. Plus, if they are not able to deliver within 2 weeks, then there would be a performance penalty of about, let's say, 10%. So these are variable considerations, these are probable, right? And then you have rights of return. For example, let's say the company has a choice, has a right to return the services that, or return the goods within a period of, let's say, a 6 months or a year, with certain amount, with certain lesser amount. So there is definitely a variable part of it. Then you have similar way the incentive discounts based on certain performance. It may be based on linked with the certain performance, or It may just be a marketing strategy to show the discounts. And then you have clawbacks. So these are the variable considerations which we have to give, which we sometimes give, which has to be included in the transaction prices. And then you have time value of money, where you have uh, the difference between the consideration price and cash selling price, or the expected length of time is more than a year, or there are the prevailing these are there are certain prevailing market interest rate which are applied in the context of the transaction. So let's say you have you're selling a building where the company is paying installments, right? In which are we are giving them installment of, let's say, 10 years. So there's all, even though the company may say these are interest free, but there is always a time variable, because showing as an interest free loan or interest free installments is just a marketing gimmick. From the accounting perspective, there is a time value of money which which the seller has to consider and separate the transaction price of of the goods, plus the financing, that the financing part of it, financing portion of it, which they have to recognize as separate as a finance income. So how we allocate that, we will be looking at in our step 4. But the first thing really is to understand what is included in the transaction price. Then you have non-cash considerations, which includes usually the barter agreements between the of dissimilar goods, because the barter of similar goods is not a part of IFRS 15. But dissimilar goods, yes, it's is definitely a consideration here. Then those has to be taken at the fair value, at what price normally the company is selling to third parties, or at a fair in the fair market value. It can be the shares, right? So you may be buying the building on an equity basis. So whatever is the price of your share, you may be decided at certain value, or you may say, okay, we will issue you 10% equity in our company in return of this building. So what would be the fair value of your shares compared to the fair value of the building? So you have to recognize that way. And then the exchange of the capacity also is another way of exchanging the goods and exchange, providing the as an exchange for the goods and services. Then you have sometimes other considerations payable back to customers, for example, the rebates or the slotting fees, or any other fees which you might have to pay back to the customer. If they are similar goods and services, then it will be reduced from the transaction price. But if you are paying back in terms of any other goods and services, then those will be considered as separate transaction, where you have to recognize the revenue from those transactions in a separate manner, considering that as a separate contract. So that is basically the transaction price. So we will be looking at some practical examples how we calculate the transaction prices in the next slide.